Okay. Let's see here. Lecture 1 for the... Oh, good Lord, it zoomed in a lot. All right, I shall change that. Hello. That's really weird. I had it all set. Is that about right? It continues to adjust. There's probably some really good reason for it, but let's see. No. That's still not high up enough. Look out, doggy. I guess let me go out so far that I see the frame first. Okay. Okay, sorry about that. Here we go. Is that better? Yes. All right, big stuff in this section. We're going to have 2 major exchange rate models, and then one minor one that I haven't decided if I'm going to push that on to Exam 3 material or not. But anyway, we'll see. That's not your problem. That's mine. And what I want to start with here is a model that is directly derivative of, it's not in the book, right there. I have a copy of the book. I actually don't know where I got this. Not in the book, it's from an article that J.T. Harvey wrote for the Journal of Post-Keynesian Economics, and it is drawing on the work of Andrade and Kaltenbrunner and Prates. Right? I don't know how to pronounce Andrade. I believe they're from Brazil. Well, we've had several Andrades at TCU. I'm digressing. It's late at night. This has been really tiring doing all these videos. I need to just settle down and do the video. All right. Okay, so what we've established up to now is that the financial sector is really, really important in terms of driving exchange rates. And that's going to be the focal point. And so perhaps it is fitting that this particular exchange rate theory from the post-Keynesian perspective pulls straight from Keynes's general theory in a place where he's talking about rates of return to assets, right? But he wanted to make this rates of return to assets very, very broad so that it didn't apply simply to financial assets, but to anything someone might want to hold as an asset, including a restaurant, right? So let me show you the equation first that Keynes came up with. R equals Q minus C plus L. Q minus C plus, and I want to do a little script L there so it doesn't look like a 1. That was a terrible L, John. That's not a great L. I never received any awards for penmanship, which I'm sure you're picking up on very much so in this series of videos. And this is for asset class I, right? Now, what each of those represent is, and let me find the original definitions here. Okay. Total expected return. Own return? Yeah. Own rate of return. Carrying costs. Carrying costs. And liquidity premium. Okay. So whatever asset we're thinking about investing in, there's going to be some rate of return it has. Like if you buy a share of stock, it has dividend payments. All right, so that's its own rate of return, is the dividend payment. That's sort of the explicit return that you're receiving on that asset. There's going to be carrying costs. Now, on a financial asset, those are going to be practically zero. But what if we were talking instead about having a warehouse full of grain, all right, that we were going to hold on to and then sell later because we thought that the price was going to go up or whatever? Then the carrying cost on grain would actually be quite high. But you know, usually financial assets, that's going to be pretty low. And then the liquidity premium is going to be, how easy is it to take that particular asset, and change it into a form that can retire debt. In other words, into money. Right? And for a financial asset, it's going to be very easy. I mean, we can call up or we can type on the computer and sell our financial asset pretty easily. So it's very liquid. Of course, cash will be the most liquid of all. But then, of course, cash has very low carrying costs, but cash has no own rate of return. You don't have a rate of return on cash. So liquidity premium being much higher on financial assets than, say, on a warehouse full of grain. Now, Keynes' idea was that you can compare grain to a share of stock, to a currency, to any range of assets, all right? Not just financial ones. And figure out, okay, but what is it worth it to me? Because really the total expected return is a combination of all these factors. Sure, I'm getting some rate of return, but is it costing me something to carry it? Is it costing me something to hold on to it? So if so, I need to subtract that out. And let's take cash. Even though cash has no own rate of return at all, and its carrying costs are negligible, but it's very liquid. It's very nice to have when you feel like you might need to retire debt very quickly. After the financial crisis in 2007-8, firms in the U.S., there was an appreciation of the dollar worldwide because American firms were cashing in assets and pulling cash back home. They wanted cash to retire debt. And so cash is the most liquid of all assets. So, all right, so Keynes figures that, there might not be a number per se, but in the back of your head, you're doing this, right? I mean, when you're trying to put together a portfolio of assets and you're trying to decide what your best rate of return is going to be, you're considering all these factors. And there is a sort of total that is the own rate of return discounted by the carrying costs, but then boosted, perhaps, depending on how liquid it is, by the liquidity premium. Now, he also said that the rate of return on every financial asset would be driven, every asset, John, not every financial, would be driven together, all right? That they would be driven together because if this R was higher for, let's make something up here. If actually, hey, I got one that we might actually imagine this being the case today. You're holding on to oil, okay? You have a refinery full of oil that you don't want to sell yet because you think the price is going to go up, all right? The price is going to go up at some point. Very high carrying costs, not very liquid. But you feel as if you'll be able. It may appreciate relative to everything. Which, by the way, I've left that variable out so far. But what he's saying is, if oil is more attractive than stocks, then what's going to happen is people will all jump into oil and buy up oil, and of course, by buying up oil, they'll drive up the price, the current price, which means it won't be as attractive anymore. All right. So that's the kind of mechanism we're talking about, that very common economic theory where the rates of return are driven towards equality. Now, I've got to tell you a personal story here. So, when I wrote this article and I sent it off, and normally when the referee recommends something, you're like, yeah, whatever, I'll do that, even when you don't necessarily agree. Usually the comments are pretty good. But I didn't agree with a couple of things, but I did them anyway, except this. The referee said, well, there's no guarantee they'll all be driven to equality. No, we know they don't all end up exactly the same. The point is they're driven together, all right? They may never reach the point where they're together, but they're driven together. And so a couple of iterations of sending the article back, I kept saying, yeah, but. So I'm not taking that out completely. I finally had to pull rank and quote Keynes on it because I was like, look, this is a journal of post-Keynesian economics. We're following what Keynes had to say. And guess what Keynes said about this very issue? A key assumption is that the overall expected rate of return, R, will be driven towards equality across asset classes. Parentheses, Keynes, 1936, pages 227 to 28. So anyway, I won that argument. All right. So now, but let's use this instead for currencies. because currencies are a financial asset. People buy currencies as an investment. Now, technically, well, we'll get to that in a second. I forgot the first one, Q, right? Yeah. Okay. There's that same equation for the pound sterling. And this would be the, overall return on the pound, and then the pound's own rate of return, carrying costs, and liquidity premium. And in order to, let me double check my notes here and see if I want to do this next. Yeah. Now, in order to make sense of this for a currency market, first of all, people don't actually just buy currency, all right? They're going to buy a financial asset denominated in that currency. Now, they got to buy the currency to buy the financial asset, so that's where the currency market is involved. But they're not literally buying currency and putting it in their garage and waiting for it to appreciate and then, getting a big truck and driving out and selling it at the bank. They're just buying, at the worst, a deposit in a bank in the other country, or actually it doesn't have to be in the other country anymore, but a deposit in that currency that is earning interest. Or, as I said in one of the previous videos, you could buy a government bond, which is going to be a very low risk if it's a developed nation, and you're going to earn interest on top of the fact that what you're really aiming for, though, is the currency to appreciate, so you can then sell it afterwards, right? Now, it's actually a little bit more nuanced than that, and I may get around to that later in terms of how you're playing the forward and the spot rate, but for now, let's just leave it at that. Okay, so what would the own rate on pound sterling be? Well, cash doesn't have a rate of return, but I just said, however, that people tend not to buy the cash, though. If you're going to be speculating in foreign currency, you're buying an interest-bearing asset. So let's think of Q as the pound interest rate. And what we're going to say here, I guess by the end of this set of lectures, is that of all the factors that currency dealers focus on, the one they focus on, number one, is rate of interest. All right, so let's think of this as the rate of interest on the pound. Okay, so when we're thinking about what is the overall rate of return on the pound, the first consideration is how much interest can I make from a pound deposit or from a British government bond. Carrying costs. Well, they're not much for cash, but this is a handy place to include something that developing countries will have to deal with. And that's one of the reasons to cover this whole section here and this whole model, is to talk a little bit about the developing world rather than just the developed world, which is what the class used to be until I introduced this a couple years ago. Well, what year did the article come out? 2019. Until last year. Actually, I think I've done it for 2 years because I think people had the draft paper before that. So this is going to be capital controls, all right? Again, as we will talk about throughout the semester, the problem is that when people in the developed nations tend to invest in a developing nation, when they decide things don't look good, the money will... I'm sorry, I'm distracted by the dog right now, trying to figure out what the hell he's chewing on. Hang on. Coble, what you got? Oh, okay, it is his toy. He's laying next to a blanket, which we would rather he didn't chew on, but he's actually chewing on his toy. So the money can leave very quickly. As we will talk about in the financial crisis section, when we talk about the Mexican financial crisis and the Asian financial crisis, is that the money left overnight, all right? So it behooves developing nations to put in place capital controls that say you're not allowed to do that. But capital controls also discourage people from investing there in the first place. So these are better for economic development because it means that the financial markets are less unstable, but you're also less likely to attract foreign investment. All right, so that's the drawback. So, but it's not really a big deal for developed nations. We don't really have capital controls to speak of. but developing ones do. So I want to include that. That's what for carrying costs. This is not the exact same thing as a carrying cost, but it's a cost of investing in Venezuela. If Venezuela has rules on when you can withdraw the money and when you can't. Then the last one we're going to keep is liquidity. How did I word it here? Yeah, liquidity. Let's see here. Yeah. Keep that as liquidity premium just as it was before. How easy is it to use this particular currency to retire debt? And guess what? There's an international hierarchy of currencies at which the dollar is on top. If you were thinking about holding the savings that you have in any currency on the planet, well, let's see, pesos, rubles, euros, dollars. Dollars are the safest of all, and dollars are accepted across the planet. So the dollars will be extremely liquid. So that's the last factor we're going to include in here. So whenever we're talking about how investors view this currency. See that? How investors view this currency, we're talking about, they're going to look at the interest rate, they're going to look what kind of capital controls there are, and they're going to look at the liquidity premium. And generally speaking, if you're a developed nation, this is going to be pretty high, highest of all for the U.S. And if you're a developing nation, it's going to be pretty low. All right, so that's going to be the issue. All right, let's see. What have I got next here, John? So that changes it for that. Yep, said that. All right. Let me show you this. We still have one more variable to add to the equation, all right? But let me wait to do that just a second. Oh, no, look what I did. Sorry. Daydreaming. I was actually thinking about what currency do I want to do next, when I'm going to do the yen. Okay, pound, dollar, yen. All I wanted to point out here, and again, we're still missing one variable in each equation, but I think it makes sense to talk about this now rather than wait till we have that in there. There's going to be a tendency to drive these towards equality, all right? If one currency is being viewed as more attractive than another, then that currency will be bid up. And it will be bid up until it isn't more attractive because, well, why is it attractive? Because we expect one day the price is going to be here, but right now the price is here. But if we're bidding up the current price, then look, the increase is getting smaller and smaller. The amount of appreciation from here to here, if we're bidding it up in the short run, is getting smaller. So we're expecting then that whichever ones are having viewed as having the highest total return, they're going to be bid up until we drive towards equality. Yes. Now, I think I'm ready to add this. Well, no. Now I want to tell you something about the problem that developing nations have and developed nations have, because we can already do that even without adding the other variable yet. And let's do... Kind of wish I hadn't erased all that now. I'm going to do the U.S. And then, well, let's just do it this way. All right. Yeah, should I do a second developing economy? Or what the heck is it's in the book. As I said, I'm really tired. Let's see here. But by God, I'm going to get all this done before the semester starts. The currency in Thailand. Baht. Okay, the Thai baht. All right. So, here's what I want to talk about now. I want to talk about the different kind of problems that developing nations face versus developed nations face. Well, actually, the bottom line is that the developed nations face a problem, the developing ones don't, which is the way it often works out, isn't it? Among developed nations, U.S. and the U.K., these numbers here are going to be practically identical between the two countries. There's not a big difference between the capital controls in the UK and the capital controls in the US, nor is there a really significant difference. I mean, the dollar is preferable, but a huge difference between the liquidity preference for, or liquidity, what word am I using? Premium for the dollar versus the pound. So, for the most part, developed economies, their currencies react the most to changes in the interest rate. All right? Remember that. And we're going to talk about that a lot in the third part of the course. That the primary factor that's going to be causing fluctuations between, there's going to be a lot of other factors too, so I'm not saying this is 90%, but the most consistent factor that causes fluctuations here is going to be the interest rate. I pretty much guarantee if the Bank of England jacks up the interest rate, then the pound's going to appreciate. Right? Those numbers are almost identical between those two countries. So really, most of the action you see in the developed world is going to be along the lines of changing the interest rate. Now, down here, quiet dog. There he is. Down here, their problem is going to be this. First of all, they can't compete possibly compete with the developed world on liquidity. So they're at a disadvantage already. And they want people to buy their currency. You know why they want people to buy their currency? Because they want your currency. All right? Is he finally going to stop? I was going to go in there and try to explain to him that we're doing a lecture here. He stopped. All right. They're not going to be able to compete there. All right. So they're already at a disadvantage. And they want you to buy the Thai baht. They want you to buy the peso with the dollar or the pound. So they will have those dollars and pounds that they can use to buy goods and services in the rest of the world because it's a hard currency. It's a currency that their people are going to be much more willing to accept than a peso or a baht. All right. So, yeah, especially since I picked the currencies of two countries that we talk about later that had financial crises and saw their currencies absolutely collapse. So they want people to buy their currency because they want you to buy their currency so they can have yours. All right, so this is important to them. They can't compete along those lines. So what they're going to have to do is either have very high interest rates to attract your foreign money, which is bad for domestic development. I mean, as you can imagine, if interest rates are really high, then firms aren't investing and people aren't buying anything on debt and so forth. And so that doesn't work out well. And remember I said how it's advantageous for them to have some capital controls to put some stability in their financial market? Yeah, but you put capital controls on, you're not going to get any money. You're far more likely to attract money by just saying, hey, buy our stuff, but leave anytime you want, but please don't. But, we don't really have a law for that. So developing economies, given that their currencies are at the bottom of the international hierarchy of currencies, which means they have really low liquidity premiums over here, they are forced to compete by having high interest rates and low capital controls, which really sucks because both of those things are detrimental to economic development. Meanwhile, so it's a very different world here. The kind of issues we'd be talking about if and most of the class really focuses on this up here, only because that's where my interest lies, not because that's the most important thing. I did want to stop and make sure you understood, hey, by the way, though, this is a really much more complex and difficult issue for developing economies, because since they can't compete along this line right here, they have to compete here and here. Meanwhile, up here, we can see that most of what's going to go on among developed countries is going to be related to the interest rate. And so, as John Harvey says in the paper, just that far into the theory, you're like, oh, there's something I already learned. There's something I can grab onto and make sense of. This seems like to imply something tangible about real-world policies and about some problems that exist with those policies, how the system is set up, and the system makes it difficult for the developing economies to develop. All right, let's see. That brings me to what point here in my notes? Let's see. If I'm using my study questions from 2019, we're up to question 50. Okay, so now we're at 51. Cool. All right. To erase all this. Now, here's the variable I've left off all this time, okay? Something that hasn't been included, and let's see, should I do it this way or this way? It's on this page here. If you're looking in the article, I'm looking on page 393. And I'm sorry, I don't know that I ever actually said the title of the article. It's going to be linked in your course materials. What is the title of the article? I don't even know. Where's page 1? I have taken oh, here it is. Okay. It's called Exchange Rates and the Balance of Payments, Reconciling an Inconsistency in Post-Keynesian Theory. All right. And I'm on page, what did I say, 393? Yeah, right down here where you see equations 2 and 1 prime, that's what I'm about to talk about. Okay, so here's the variable I've been leaving off. Let's do And Keynes includes this for the asset classes he's talking about. He kind of sets it up the same way, because that's kind of where I copied it, and where Kaltenbrunner and Andre and Prate copied it as well, was out of that part of the general theory. By the way, another secret fact, I was the anonymous referee for those 2 other papers that I am now citing here in this one, and that's why I was so familiar with him, and I really liked him a lot. So let's see here. Okay. The thing we haven't taken into account, and by golly gosh, is the one that's going to be the most interesting to us, is this one. The expected appreciation of the pound against the dollar, right? So we haven't really had anywhere to include in the equations, and again, Keynes does the same thing. He adds this in late. After he's kind of taught you how these things work, he said, okay, now let's start talking about how the price of this thing can change relative to the price of this thing, all right? And so, as you can imagine, this is going to be a major focal point when we're talking about exchange rates, is because here's those expectations we keep talking about. Here's the expectations that are going to drive the decision making, that are going to be driven by those psychological factors that we talked about before exam 1. There's the expectations. And now notice here. Now notice what we got. The overall sense of the rate of return of the pound is a function of the pound interest rate, of capital controls in the UK, of the liquidity premium, and of whether or not we think it's going to appreciate before, relative to the dollar. By the way, notice we don't do this. Notice we don't do we don't need to do it twice. We've already got expected appreciation against the dollar up here. We don't need expected appreciation against the pound. We've already got it up there. In fact, it would be it would actually screw up the math at that point. So there's the expected appreciation of the pound. So notice here, notice something. Hey, and let's assume that between these two countries, what color do I want to use here? That these are identical in both countries, so we don't even have to think about it. And these are identical in both countries, so, you know, it could be some number. I'm not saying it's 0, but it's the same number in each one, all right? But let's say that this one is 0.07. The interest rate on government bonds in the UK is 7%, and the interest rate on U.S. bonds, government bonds, is 9%, all right? Could this be an equilibrium situation for the pound and the dollar? Yes. If, oops, I'm sorry. That's expected to appreciate by 2%. You see what I'm saying? That, yeah, the interest rate on pound deposits or on pound, government bonds is lower than the U.S., but people are expecting the dollar to depreciate. And so the market is therefore in equilibrium. Even though the interest rates are not exactly the same, the market's in equilibrium because there is a general expectation that the pound is going to appreciate and the dollar is going to depreciate. So that's the role this plays. The role this plays is that what it means is that the rest of this equation doesn't have to be equal. For these two to be equal over here, let's see, green. In order for these two to be equal, it is not necessary that those are equal, because we also have to take into account, in fact, especially this is a really important part of the whole thing, what agents' expectations are about the future value of that currency, all right, over the same time horizon as we're talking about for these interest rates right here. Let's see. Let me see where I am in terms of the study questions here before I go into that more deeply. Oh, well, let me show you this next. What if you're talking about a bunch of different currencies? Don't tell me. C yen plus L yen R euro equals Q euro minus C euro plus L euro, and then the dollar. R dollar equals Q dollar minus C dollar plus L dollar. Okay, here's my question. How many of those need an A variable? And the answer is n minus 1, where n here is 4. I mean, however many currencies we have, it's always n minus 1. Check it out. Don't need one on the dollar, because what we're doing is we're including in every equation, that's supposed to be an A, it looks more like an L, doesn't it? We're including in every equation in how much is the pound expected to appreciate against the dollar, and how much is the yen expected to appreciate against the dollar, and how much is the euro expected to appreciate against the dollar. We don't need to put it in for the dollar, all right? Now, what about these two relative to each other? Well, you can just infer that from this, all right? For example, if the euro isn't expected to move at all relative to the dollar, but the yen is expected to double in value relative to the dollar, well then clearly the yen will also double in value relative to the euro. So you can figure out the expected movements among these by doing the appropriate mathematical conversion to those factors right there. But and also what Kaltenbrenner and all of them suggest that you do is that we could have done this with any of them, right? We could have said, hey, let's make it relative to the yen. So this is how much the pound will appreciate relative to the yen, how much the euro will appreciate relative to the yen, and how much the dollar will appreciate relative to the yen. And we would have left nothing there at all, right? Wouldn't have needed that. But what we should probably do is set it up to where the default currency is the one that's on the highest point of the hierarchy. And it's the dollar. All right, so we're really, well, it's by far the most financial transactions, international transactions are going to be between these two right here, by the way. And this one is going to be involved in the vast majority of currency trades. So this is going to be our question that we're going to say, relative to what currency? Relative to the dollar. That made me think of something else for a second, or I thought it did, or is that? I think that's it. Oh, I know what it was. And bear in mind, of course, that could be a negative number. In other words, we expect it to appreciate relative to the dollar negatively, which is the same thing as we actually expect it to depreciate relative to the dollar. So it could be a positive or a negative number. It doesn't always mean appreciation. Oh, man, I guess it technically always means appreciation, but appreciation can be interpreted in this context as negative. Okay, next part. Yeah. What are you doing, buddy? He's looking for something. What's he looking for? Whatever he can find. Yes. Melanie's already in bed. You can go in there if you want to and lay down and get petted. He doesn't want that. All right. Let's see here. Also, he doesn't speak English. Right. Okay. Now let me define. Yeah. Now I love this stuff. All right. Wait a minute, let me make sure I drew it right. Yep, okay. So, right. Okay, what is that expected appreciation number? And we're going to need to break it down. It's going to be necessary to break it down a little bit further than we had there in the equations. I mean, hopefully in the equations it was kind of easy to, like when I showed the first example with the 0.07 for the interest rate in the UK and the 0.09 for that in the US and the 0.02 for the rate of appreciation of the pound against the dollar that's expected. I'm like, oh, okay, yeah. If we expect it to go up by 2% in terms of value, then yeah, a 7% interest rate is equivalent to a 9% interest rate. But we actually need to break it down a little further than that. For this reason, that very often, what's going to be changing? Well, two reasons. One, we want to find out when this changes, which variables it affects, and very often, it's going to be that changes first, before everything else. Because that's the forecast. And of course, that's what we were talking about leading up to the first exam, was all the stuff about currency market participants creating their forecast. Well, where does that variable show up? It's right there. All right, that's where it is. And so this is the dollars per pound expectation on the part of market participants. The S is the one with the S is the spot rate. Now, let's see here. I'm going to need to give you some examples. First of all, well, let me check this first. Yeah, okay, so that's all of 51. Yeah, I'm going to need to drift off of that now and just make stuff up. Okay, so check this out. Let's see here. I'm going to erase this, but let's see. I will write this. No, let's just do it like that, John. Not a bad idea. Okay. All right, let me rewrite the equation and think about it a little bit more closely. And then, now this is going to be, but then below it I'm going to write what that breaks down into. spot, expected. Okay. So that A right there actually expands into that. Okay, so the A right there is really three variables. It's the what we expect in the future minus what's true right now divided by what's true right now, because that way we get a percentage change. Right, we want to divide it by what it is right now. For example, let's make up a couple of numbers here and let you see how that works. Let's say that the spot rate and why didn't I do it that way in the paper? It's a lot of it would get really messy. So I just did it with the E. Is that what I said? I don't even remember now. Yep, that's what I said. EE minus ES over ES. Okay. So let's say that it cost $2 to buy a pound. All right, and that people are expecting in the future for it to cost, let's make it math simple, $1 to buy a pound. All right. So let's multiply that out. Let's put those values in there. All right. So we've got 1 minus 2 over 2. There's the spot rate and there's the future rate. So we've got negative 1 over 2 or negative 50%. And that's right, the pound has lost half its value. Note here that this is a pound depreciation. People are expecting a huge pound depreciation. They're expecting it to go from, it used to cost $2 to buy a pound, now it's just $1. Pounds are really cheap, all right? So this is people expecting a huge pound depreciation. And look what we got. We got negative 50%. We got 1 minus 2 over 2 is going to be negative 0.5 or negative 50%. So this number would be negative 0.5. In the example I gave a minute ago, I made plus 0.02. So it was going to be, they were expecting a 2% increase in the value of the pound. So that's how that multiplies out. It's really very simple, but I know how it is. This can get tedious when you get to have so many variables and think about, and plus when it's two different currencies. You know, sometimes your first inclination is to think, oh, this is a more valuable dollar because it's $2. No. That's how much it costs to get a pound. And if it costs $2 to get a pound versus 1, that sucks. The dollar's not worth as much because it takes 2 of them to get 1 pound as opposed to 1 to get 1 pound. All right, so that's what that number means there on the far right. Now, let's see. Yep. Hello, puppy. Actually, I think I want to do an example from the article rather than from there. What I wanted to show you was... No, not you. Let's see here. What do I want to do first? Okay, let me show you this. Let me show it to you this way. Let's say that the situation right now is such that the market is not in equilibrium, that in general people believe that the pound rate of return is better than the dollar rate of return. Something has to adjust. I referenced this very vaguely earlier. Now I'm going to have to do it very specifically. Something's going to have to adjust to make it equal to, all right? And let's see. No, don't do that. I was going to give you an example from another area of economics, but that actually might make it worse. Let me write that whole thing out. Not just, actually, let me write this out in the full equation. Okay, so all I did was I substituted Q minus C plus L plus A for R here, and Q minus C plus L, we don't need the A, of course, in that one, for the US. And let's say the left-hand side is bigger than the right-hand side. Here's the key question. All right, and this is where you start using this model to figure out what's going to happen in the currency market. Something's going to change. Everyone's buying up pound assets. No one's buying dollar assets. That's not entirely true. Some people are, but there is a net capital flow into the UK. Remember the graph at the end of the last exam. People are buying UK financial assets in excess of how many they're buying US because of the better return. Either because they're offering higher interest rates, or there's lower capital controls, or the UK's pound is more liquid, or people expect the pound to appreciate. It doesn't really matter at this stage. All we're saying is this side is bigger than that side. What's gonna adjust? Well, okay, let's go through the list here. It is exceedingly unlikely that between two highly developed nations there ends up being an adjustment of which currency is more widely accepted on the planet, just because of the fact that this is bigger than this at this point. I mean, that happens. The pound appreciates sometimes, and the dollar appreciates other times. So that's not going to be the issue. And I already said those are almost identical for developed nations. They really don't have any capital controls in either country either. So those are kind of a non-factor. So we're only left with three variables: this one, and this one. And asking the question, what is it that's going to adjust to make these be equal again? Now, these are interest rates. And it might be tempting to argue that as capital flows into the UK, so UK interest rates fall because there's so much, they don't have to offer as high an interest rate because everyone's putting their money in the UK. All right, so banks don't have to, pardon me, offer as high an interest rate. Capital is becoming abundant. Financial capital is becoming abundant in the UK, and likewise, financial capital is becoming scarce in the US. So interest rates are going up. That's not going to happen between two advanced developed nations, and you know why? Because the Fed targets that, and the Bank of England targets that, and they will just hold them where they are. The word is sterilize. They will sterilize the flow. As the money flows into the UK, the Bank of England will absorb it. As the money flows out of the US, the Fed will inject new money. All right, so they will sterilize those movements. So that's not going to be the answer. All right, that's not going to move. And that's not going to move, all right? Now, if these were developing nations, you might see something like that. The developing nation where everyone's leaving and taking their money out, their interest rates are going up too, which, again, really sucks for them. But in a developed nation with a modern central bank that targets interest rates, they're holding them still, all right? So that's not going to happen either, all right? So we've only got this left. We've only got that one left. And let me write it out again. And that's right. This is where the action is going to be. Let's see, what color do I want to use now? Blue. I'm going to write it out again. Now, let us initially assume, this is going to be on page 394, right after equation 4. Yeah. And solve for A. Oh, no, actually it's 393. No, it's 394. It's at the top, though. Okay. Let us initially assume that this stays constant. I'll put a line over for that stays constant. That the expectations are based on a variety of other factors, And we're not going to change the forecast. And so instead what's going to happen is the spot price is going to start moving. The spot price of the pound will start moving as a result of these net capital inflows into the UK. And in particular, the pound will become more expensive, right? The pound will become more expensive. So what's going to happen is that number is going to get which one, larger or smaller? If the pound is more expensive because everyone wants to buy the pound, if the pound is more expensive because everyone wants to buy the pound, then more and more dollars per pound. The denominator will also go up, but what we're really concerned about here is the sign. The sign is going to be the big deal. The sign of this thing right here, the magnitude of it. And so if this is getting bigger, that's getting smaller. Oh my God! If this is getting bigger, that's getting smaller. If this, I'm sorry, I just said that backwards. No, I didn't say it backwards. I did this though. If this is getting bigger, that's getting smaller. If this number right here is getting bigger because everyone's buying up the pound with dollars, and so they are causing the value of the pound to appreciate today, right now. So if we have the higher rate of return for the pound than we do for the dollar, guess what? The pound appreciates. What a surprise. And we can see it right here. This number gets larger, which makes this number smaller. And why is that important? Because as the pound appreciates while holding expectations constant, this gets smaller, returning this to equality. Returning that to equality. So, let me summarize that. If we find ourselves in a situation where the market expects a higher rate of return overall on the pound than on the dollar, then the primary mechanism that will drive it back to equality or towards equality is the fact that the pound is going to start appreciating. And when the pound appreciates, this number gets bigger. And as it gets bigger, that shrinks. So if this is shrinking, then it's going to be a lot bigger. The greater than sign doesn't really do this, but pretend it does. When it's not as much greater than, and then boom, it breaks apart when they're equal, right? So imagine that. It's a lot greater than. It's not as much, they're equal, all right? So that's what's going to happen here. As this goes down, it's going to return it to equality. Makes perfect sense, all right? So notice, let's do this again. Actually, that's not put an equal sign there at all. Okay, there's dollar, there's pound. And remember, with a developed nation, no big deal, no big deal, no big deal, no big deal. So now we're left down to the interest rates. Fed decides to jack up interest rates. Wham! All right? What's going to happen? The money's going to flow. The money's going to flow from the UK to the US. The dollar is going to appreciate, which means this number gets, let me use a different color. This number gets smaller and smaller. It takes fewer and fewer dollars to buy a pound, which makes that number bigger, which moves us back to equality. So when the U.S. jacks up the interest rate, it leads to a dollar appreciation, which brings us back to equality, which makes sense. You raise the U.S. interest rate, and then the dollar appreciates. You lower the U.S. interest rate, the dollar depreciates, and so on over here. And now, okay, next thing that I want to get to. Because we haven't brought up the most interesting scenario of all. Don't tell me. Q. I forget every time that it starts with a Q. And then Q dollar minus C dollar plus L dollar. Okay, so there's your U.S. rate of return and your U.K. Total rate of return on holding pound sterling. All right. Oh, yeah. This is what I wanted to do. Now, what happens if we go back to the previous chapter and talk about agents going through, because this is, I already said neither of these are a big deal, neither of those are a big deal. The Fed and the Bank of England are going to target these for months, sometimes years at a time. So if none of these turns out to be relevant on a day-to-day basis, how come exchange rates move all the time? How come there's so much volatility in the exchange market? Because of that one. Because of that one right there. Because the forecasts are changing. All right. A, there's more variables than these right here that are. This is a. As with any model, it's a simplification. But B, really, this is the one that's changing all the time. This is the one that has the rapid fluctuations as people try to anticipate what various policies will be and so on. And so, let's see what happens. What if agents expect a cheaper dollar? If this is going up, it means they're expecting a cheaper dollar in the future, right? Because more and more dollars relative to the pound. Well, if this is going up, remember blue. Remember, those two are the same. That's simply what a pound is. That's what a pound is right there. A subscript pound. If that's going up, then what's a subscript pound doing? What's going up? All right, so then the left-hand side is bigger than the right-hand side. All of a sudden, the expected return on the pound looks better than it does than the return on the dollar. So what do? You go by the pound, which causes the pound to appreciate. Mon Dieu! It drives that up, which is then going to drive that back down again. In other words, when people expect the pound to appreciate, the way this returns to equality, because initially that causes the left-hand side to be bigger than the right-hand side. The way it returns to equality is that after they expect the pound to appreciate, the pound then appreciates. Because when you expect the pound to appreciate, what do? You buy the pound, which causes it to appreciate. So, when this goes up, it causes that to go up, all right? And most of the action in this model is going to be, for a developed nation, is going to be this thing bouncing around, causing that to bounce around. And then there's going to be some changes here now and then, but not much on CNL. Now, was that everything for that article? Oh, I really enjoyed that. I hope you did too. Let's see here. I did more than I usually do. I went into more detail on it. That was good. I only want to say one more thing here then. And that is that I do want to emphasize what I ended up emphasizing for that stupid referee, that no, we can't necessarily expect exactly that to happen. But then, of course, that number is not printed in the paper. We don't really know what that number is. That's a subjective, or not even. It's not even subjective. It's not tangible. It's intangible. Is it intangible? I don't know. And so, but B, you only drive these together as far as your level of confidence makes you feel good about it. In other words, if the expected rate of return on the pound was net on the planet, with all the market participants, 0.002 percentage points different than the dollar, that may not be enough to make me think, yeah, I should buy some more pounds. All right, there's a point at which it's like this. If you thought the Cowboys were going to beat the spread in a football game, how much money would you bet? Depends on your level of confidence. The more confidence you've got, the more you're going to bet. It's the same game here. The more confidence people have, the more these are driven together. The less confident they are, the more they can drift apart. And then the very last thing, and I mentioned this because a student last year said she really liked this, so I kept it in there. Recalling the reason why there is no assumption that we would actually ever reach that, the article argues that this does not, at least in terms of the paper's thesis, change anything significant in the theory. However, what I just said serves as an important reminder that the objects of our study are what? The objects of our study, that's these dealers, are not coldly rational, mechanistic, utility maximizing individuals operating in an environment of complete certainty or risk. All right? In other words, we don't have complete certainty. These people aren't robots. Rather, these are social beings struggling to make sense of the uncertain world around them. All right? So we can't get carried away just because it's an equation. It's an equation about human behavior. So we don't expect it to exactly hold. Who knows how close it would actually get in the real world, or who knows if we got to change the equation next week. We're talking about human beings. We're not talking about, and economists sometimes are insufficiently careful about the fact that they forget that their object of their study are just people. Thank you.